Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Thank you to all of you listening in today. As always, this is the Healthy, Wealthy, and Wise Retirement Podcast, and I am your host, Lauren Sherman. I started down this career path all the way back in 2006 when I would fill my day with about 6 or so appointments 3 days each week. I would drive from town to town around Iowa discussing retirement planning with people 60 years and older. While this was a great learning experience, I'm grateful for the opportunity now to reach out to so many retirees all at once as we gather together every 2 weeks for a new topic. With this thought, if you know of 1 or 2 other retirees or soon-to-be retirees who could benefit from listening in, I greatly appreciate you sharing the word. And I know many of you already have done this, so a sincere thank you to all of you helping us reach more people. On to the topic of the day. And this one is important because so many retirees are missing opportunities each year to potentially put thousands of dollars back into their plan. With that intro, today's chat is titled Harvesting Tax Gains or Losses for Year End. If you are anything like me and you grew up around Iowa, the word harvest had everything to do with getting corn out of the fields and nothing to do with tax planning. Many retirees overlook tax harvesting opportunities, but the good news is it's never too late to introduce great ideas to your retirement strategy. We will help break down the concept in a minute, but before jumping ahead and implementing any of these strategies, be sure to stick around to the end where we cover pitfalls that you will want to be aware of. We will cover which accounts tax harvesting applies to and how to actually go about it, but first, some of you may be wondering why tax harvesting is important in the first place. This is a good question because tax harvesting often falls into the category of we don't know what we don't know. Many go about their retirement never realizing tax harvesting was even an option. Don't feel bad if this is you, as many advisors overlook this strategy too. Financial advisors often stay away from tax advice of any type, sticking only with investment management or other areas of expertise. With that said, experts estimate tax harvesting to add somewhere between 0.25 to 0.5% of value depending on your specific opportunities. But percentages don't tell much of a story, so let's take a look at the following scenario. Imagine for a moment that you are 65 years old and you just retired. In one account, you have $500,000 where we will be able to use tax harvesting strategies. For the sake of this example, you're in fine shape to cover all of your expenses each month, so no additional income is needed. You'd like to help out your 4 grandkids a bit, but the budget is a little tight. Where can we find some extra dollars? It may not amount to much the first year, but with proper tax harvesting and a little time, we could gift all 4 grandkids a little over $10,000. This could help them pay off college debt, start a business, or perhaps help purchase their first home. Let's back up for a second. How did we find over $40,000 where we could gift each grandchild $10,000 each? Well, in the scenario just mentioned, we used an account of $500,000. And to highlight the benefit of tax harvesting, remember just a minute ago we said that using this strategy properly can add between 0.25 and 0.5%. So we split the difference between the two. We also used a conservative 5% growth rate and gifted each grandchild the money after the 15th year, giving it some time to grow. Keep in mind, this was not a matter of tightening the belt and saving more money. This was simply finding new money with a tax harvesting strategy. You can do a bit of napkin math on your own to see the long-term impact tax harvesting could have in your own plan. Do you have a $1 million account and plan to get a bit more aggressive for a longer time frame? Setting your plan in motion for 20 years with a 7% return, you would end up with over $150,000 extra. That's $37,500 that you could divide up between 4 grandkids, or you could simply add it to your own retirement plan. Once again, this example is using the same assumption of 0.35% added value via tax harvesting, which is splitting the difference between the 0.25 and the 0.5%. Now that we've explored how impactful tax harvesting could be, the next question is, where can I harvest gains or losses? So before we get ahead of ourselves, it is important to know where you can tax harvest. You cannot use this strategy in any retirement accounts as they are already tax deferred. This means your 401k, 403b, SEP, Simple, IRAs, all of these types of accounts are off the table. This doesn't work within tax-free accounts like a Roth either, as this money is already sheltered from further taxation. This strategy only applies to taxable investment accounts. If you're not sure how much you have in each between tax-deferred, tax-free, and taxable, it may be time to dump everything onto the kitchen table and do some organizing. You can do this on your own, or a financial advisor can help, and many have some pretty cool technology to analyze each account too. Let's hit pause for a quick moment. We started off by covering why an investor would tax harvest. We talked about the potential long-term impact of tax harvesting with a couple of examples. We showed how one individual would be able to gift $10,000 to each of their 4 grandkids. And another example, how a couple with a larger account and more time was able to add $150,000 to their own retirement plan. Of course, after that, we emphasize that these tax harvesting strategies can only be accomplished in a taxable account, and you cannot use your tax-deferred or your tax-free accounts. Now, let's move on to tax gain harvesting. The strategy of harvesting gains is not often discussed, and it's frequently overlooked altogether. For 2021, if your taxable income as an individual is less than $40,400 or less than $80,800 as a married couple, you may have an opportunity to harvest an asset's gains without paying any federal taxes. Keep in mind, state and local taxes still apply. So again, those numbers are just over $40,000 as an individual or just over $80,000 as a couple. By harvesting gains each year, you can use the money for income when it's needed without paying taxes. Let's talk through an example. Donna and Cindy have a mutual fund that has done well over the past few years, increasing from $30,000 to $50,000. Without tax planning, they may be forced to pay the 15% capital gains rate on their $20,000 gain when they need the money. This could likely bump up their state tax rate a couple percent as well. If their taxable income is a combined $70,000, they could harvest this gain over a 2-year span and pay nothing at the federal level, and they save 2% extra at their state level too. If you're anything like me, speaking in terms of percentages doesn't mean much, so let's convert this scenario into real dollars. Don and Cindy would have saved about $3,400 on their tax bill by filling up their 0% bracket instead of adding to their 15% bracket. Remember, this is money saved, not simply deferred to pay the tax later. You can start to see how over the course of 10 or so years, harvesting gains can be a powerful tool for those who fall under the income limits. Even if your income is higher, for the year 2021, you can fill up the 15% bracket as an individual with income up to about $446,000 or just over $500,000 as a married couple. Beyond this, you are in the top rate of 20%. This, however, is still much lower than income tax brackets, and we may see investors make use of this strategy in speculation that capital gains rates could be eliminated altogether. For more on this, you can check out my episode titled Taxes in Retirement Workshop, which is linked in the show notes. Now that we've gone over tax gain harvesting, let's flip the script and talk about tax loss harvesting. Tax loss harvesting is the more well-known strategy and popular for those with larger accounts. This allows us to offset gains within our portfolio and even offset $3,000 of taxable income each year or $4,500 for couples filing a joint return. This concept is similar to what we just covered, but in reverse and without income limitations. Once again, I always feel like these concepts are better when they come to life. So let's review a real-life example with Bill and Carol. Bill and Carol know they are properly diversified because even though their portfolio as a whole continues to go up, Each year they often have some investments that are winners and some that are losers. Investment ABC went up from $100,000 to $110,000 for the year, so a $10,000 gain. Investment XYZ had a tough year, going down from $100,000 to $80,000, so a $20,000 loss. Bill and Carol have the option to harvest on both sides here. Their $10,000 gain can be offset with their loss. Additionally, they can offset $4,500 from their income tax. And last, they still have a $5,500 loss left over that can be carried forward to future years when needed. Alternatively, they could have harvested just $14,500 of their loss to match up with their gain and their income tax. It can get a little tricky to analyze multiple scenarios and with more variables involved. For example, this couple could have been in a situation where they were receiving a tax credit to help pay for their health insurance. If we would have looked at Bill and Carol's situation only through the lens of tax harvesting, we likely would have missed the offset with their health insurance, and we may have done a lot of work for no benefit. As we've talked about in past episodes, financial planning in general and tax planning particularly can be tricky, as one action can often alter many other pieces to your plan. It's a bit like playing Jenga, where you continually take one of the wooden blocks out from a lower part of the tower and then you place it on top. If you pull the correct blocks, the game can go on, but you quickly realize how connected everything is if you pull the wrong one. I'm not so sure if that analogy helps at all, but I'm always trying to think of different ways to explain financial concepts, since so much of this seems to be written in Greek for most investors. We'll close up by talking about how to keep your money invested and pitfalls to watch out for. Starting with keeping your money invested. What happens if you would like to sell certain investments to harvest the gain or the loss, but you do not need the income? You would rather keep your money invested. The good news is there's still an opportunity to make tax harvesting work for you. If you sell at a gain using tax gain harvesting, you can buy back what you just sold without waiting. This way, you stay invested and you did not even change your allocation. You simply took advantage of the tax law as written. So this one is really simple. You sold at a gain and then you immediately bought back your asset, so you're invested just how you were. With tax loss harvesting, there's one more step. You are not allowed to purchase back what you just sold for 31 days. This applies to 30 days before and 30 days after the sale. It also extends to your spouse and even other investments like options contracts that you may have, which allow you to purchase the same stock or the same fund. This is called the wash sale rule, and it's designed to discourage people from selling solely for tax benefits. This begs the question, what if you would like to take advantage of tax loss harvesting, you don't need the income, and you don't want your money sitting on the sidelines for 30 days? Well, you're in luck, because you can immediately reinvest back into a similar fund as long as it's just different enough. The phrase the IRS uses is that it cannot be substantially identical. If you're not sure what this looks like on a case-by-case basis, it's best to chat with a professional to make sure you're within the rules. Let's close up with a few potential pitfalls to be aware of. We briefly touched on wash sale rules, but some other ingredients to consider include whether your gains are categorized as short-term or long-term, whether you are paying transaction costs each time you buy and sell, whether the tail starts to wag the dog, as they say, where tax planning begins to hinder your bigger goals or cause poor behavior by always selling at a loss. Another consideration, harvesting gains will increase your AGI, or your adjusted gross income, which may have a number of side effects. Remember again, this is where we use the analogy of playing Jenga and how moving one Jenga block can have an impact on everything else. A few of these side effects could include your Social Security could be taxed at a higher rate. You could be phased out of opportunities for Roth contributions or for deductible IRA contributions. It could eliminate your ACA health insurance premium credits. This one is the one we mentioned earlier in Bill and Carol's story. And it could also cause Medicare IRMA to kick in, which for those not in this category, this is probably another one of those financial phrases that sounds like Greek, but IRMAA stands for Income Related Monthly Adjustment Amount. And it's an additional amount some pay for Medicare due to their higher income. That's just 4 quick examples of an almost endless list, but it's a little peek behind the curtain as to how complicated proper tax planning can be, so much so that it's avoided by many individuals and advisors alike. With that said, using the proper tools and within the right fit in your overall retirement plan, tax harvesting can offer tremendous value. Who knows, it may even turn into that down payment for your grandkids' first home someday. That will do it for tax harvesting for today. I know I brought up a handful of pitfalls at the end that we didn't cover in much detail, but I wanted to keep this somewhat high level. Perhaps in the future we will dive into more details for those who want to do this on their own without an advisor, or if you're just the type who really likes to look under the hood and know exactly how everything works. As always, we will chat more in 2 weeks, and in the meantime, if you'd like a tax audit of your own plan, or would like to see a full retirement readiness analysis, I encourage you to use the link found in the show notes, and I'd be happy to connect.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.